Okay, dear students, let's just start our very first live revision class for the session June 2025. The topic which we'll be starting today, that is cost of capital. Before I start the topic cost of capital, I really want to know what is the status. Can you please quickly share with me how many lectures each one of you have seen so far? And I hope each one of you have also have received the planner from the admin. I hope everyone is having the planner as well, study planner. There's a lot, whatever others. Six. You should ask the planner, admin will give you the planner. Any student who does not have a planner, do ask admin. Okay. What about others? Please quickly share how many lectures, what is the status you have seen? Okay. Okay, so the first two classes, first two live revision classes, they will be very small. The duration will not be long at all. Excuse me. But after that, duration of the class will increase. And when I say increase, it will increase. Day will remain only one, that is Sunday, every Sunday, but duration will increase. And slowly and gradually, after just, I would say, couple of classes, you will always be shared before at least 3 to 4 days before the class, past papers, which we will be discussing. So it means at least 3 to 4 days before the class, you will get to know that what past paper we are going to discuss. So you'll be having around 3 to 4 days to attempt those questions. And plus one more thing, you will also be getting during the live revision classes, you will also be getting the, I would say, short notes, the key area of the topic, and plus the exam history as well, that how many times and when that particular topic was examined. So let's start the cost of capital, weighted average cost of capital. Now look at this. This is the exam history. The topic cost of capital, it has been examined. Sometimes they've asked the complete VAT question. March, June 2023, it came in question 1. Then December 23, it was a part of question 3. So this is the analysis of past exam regarding cost of capital. Okay, now come here. Introduction. The WACC is derived by finding a firm's cost of equity, that is K, cost of debt, KD1 minus T. Average them according to the market value of each source of finance. The formula of the WACC, that this formula will be given to you in exam. Okay, now when we say cost of capital, actually cost of capital simply represents cost of financing. Obviously, in order to make investment, your company is going to raise finance from different sources. Each source of finance will have its own cost. So first, what do we do in cost of capital? We calculate cost of individual sources of finance, and then we convert that into weighted average. So cost of capital simply represents cost of financing. Okay. So what is cost of capital? Simply cost of financing. And what is the objective of cost of capital? Student, please, can you answer? What is the objective of cost of capital? Why do I need to calculate cost of capital? Please reply. What is the objective of cost of capital? Let's see. Yeah, that's great. The objective is investment appraisal. Objective is investment appraisal. Obviously, before making the investment appraisal decision, I need to know the cost of capital. After that, I can go for investment appraisal. Because cost of capital will let me know what is my cost of financing. Assuming my cost of financing is 10%. And the project in which I want to make investment, that will give me the return just 3%. I will not make the investment. Because that's a loss-making project, because project is giving me a return only 3%, whereas the cost of capital is 10%. Why would I make investment? So objective of cost of capital is investment appraisal. Plus always remember one point, students, investment appraisal is a long-term decision. What did I say? Investment appraisal is a long-term decision. This is small point will also be workable later on when we'll be discussing. So don't forget this also, that investment appraisal is a long-term decision. Now, when we say cost of capital, so we know that cost of capital represents cost of financing. In order to make investment, company is going to raise the finance from different sources. Each source will have its own cost. If company raises the finance in the form of equity, then the cost is KE, cost of equity. How do we actually calculate KE? We can calculate KE by using CAPM, capital asset pricing model. We can calculate KE by using dividend valuation model. There is one more possibility, that instead of using capital asset pricing model, we might use the alternative of CAPM, which is plus tax equation. Plus tax equation, another name is plus tax equation, that is preposition 2. Miller and Modigliani preposition 2. Simply you can say plus tax equation. But please listen the concept clearly. Number one, plus tax equation is the alternative of capital asset pricing model. This is the first concept. Second, assuming we are solving a question, okay, and we are unable to use, let's say, CAPM, then we'll go towards If we are unable to use CAPM, we don't have the entire information of CAPM, then we'll be looking for the alternative of CAPM, which is plus tax equation. Now listen to me carefully, student, please. Recently, plus tax equation formula, examination team has changed. Now, how the new formula look like, on that I have made a video. So please, plus tax equation, preposition 2, new formula, how to use it, new video. Make sure every one of you must watch that. If you have not seen that video still yet, and it is already on the portal, but if you are unable to find it, do ask the admin, or I will also ask the admin immediately after the class. to share the video on change in AFM, which came in MM plus tax equation. So I hope it is clear to everyone now that how you are supposed to prepare yourself for MM plus tax equation. The second is if your company raises the finance in the form of debt, then the cost is KD1 minus T. The cost is cost of debt after tax. Why do we say KD1 minus T? Because fixed payment of interest results in tax saving. That is why KD1 minus T. We never say KE1 minus T because to the shareholders we'll be providing dividend. Payment of dividend does not save tax. Payment of interest saves tax. That is why KD1 minus T. Finally, which I have not seen in any past paper, if company raises the finance in the form of preference shares, then the cost is KP, cost of preference shares. Okay, now, first of all, let's start from CAPM, capital asset pricing model. Capital asset pricing model. The formula of CAPM, which will be given to you in exam as well. K is equal to RF plus RM minus RF into equity beta. And student, one more thing, all the shortcuts which are available in AFM during our live revision classes, we'll be using those shortcuts as well. Obviously, we'll be using only those shortcuts which are available in exam. It is illogical to discuss the shortcuts which are not available in exam. So I hope it is clear to everyone. And all the shortcuts which are available in exam, you are supposed to use them as well. And plus, slowly and gradually in coming classes, we will also be discussing, there will be a discussion on how to get professional marks. Okay, CAPM. Capital asset pricing model, K is equal to RF plus RM minus RF into equity beta, KE. K is simply cost of equity. Cost of equity. Now, please always remember one point. The same thing which is cost for one party, it is a return for another party. For example, if ABC company has taken loan from the bank, so obviously ABC company is paying the interest cost for ABC company, but the same thing is return for the bank, which means that if I'm saying K is the cost of equity for the organization, when it comes to shareholder, the same thing interpretation is minimum return required by the shareholders. So the cost of equity is minimum return required by the shareholders. RM, first RF, risk-free rate of return. Risk-free rate of return. Simply, a return on government bond works as risk-free rate of return. In financial management, either it is basic or let's say advanced financial management. The benchmark for risk-free investment is investment in government bonds. What is the reasoning behind that? The reasoning behind that, why financial management says investment in government bond is a risk-free investment, because normally governments do not collapse. Normally. That is why investment in government bond is taken as risk-free investment. Plus, assuming, just make an assumption, let's say there are two government bonds in the question. One is having a maturity period of 4 years, another is having a maturity period of 6 years. Okay. Now I need to use one out of these two as RF in my CAPM formula. Logically, ideally, I will be utilizing the government bond rate which maturity matches with the life of the project. If my project is having a life of 6 years, I'll take the government bond which has a maturity period of 6 years. If my project is having a life of 4 years, I'll take the government bond rate as RF, which has a maturity period of 4 years. So this is the answer if you have more than one government bond. So which one you need to use in CAPM. But obviously examiner directly gives you RF. But I've just given you the answer. If you have more than one government bond, what to do? RM. RM is average return at a stock exchange. Average return on a stock exchange that will be given to you in exam. In our advanced financial management, we do not have any formula to calculate RM. There are other studies in which they do calculate RM, but in ACCA, things are simpler than others. So they directly give you RM. Now, RM minus RF, RM minus RF is your equity risk premium. Why do we say equity risk premium? Obviously, when you are going to make, let's say, investment in any organization's shares, you will become equity holder. And why risk? After making an investment in shares, you will have to face the risk. Why premium? Actually, premium means over and above something. Can I say without taking any risk, you can earn RF? It means that if I'm making investment at a stock exchange, so I need the return more than RF. That is why the name is equity risk premium. So now student, listen to me. Most of the time examiner, what he does in AFM, it directly gives you equity risk premium, which means RM minus RF. Another possible name for the equity risk premium is market risk premium. Market risk premium. Now, we have equity beta. Before the discussion of equity beta, you just need to know the interpretation of only beta. Actually, beta is a measure of risk. Beta is a measure of risk. And when we say risk, there are two types of risk. One is systematic risk. Another is unsystematic risk. Unsystematic risk, it is a diversifiable risk. Unsystematic risk is a diversifiable risk. It's a risk which can be spread, which can be reduced, even which can be eliminated. Now, what do you mean by this? That the risk which can be diversifiable, which can be spread, which can be reduced. It's very simple. Simply do not make entire investment in one organization's shares. If you have, I always give the example, let's say, what do you mean by diversifiable risk? For example, let's say you have 1 million in your currency, assuming. If you invest the entire 1 million in one organization's shares, then what happens? You have not diversified the risk. If that company's share price will rise, then your 100% investment will rise. If the share price drops, then your 100% investment will drop. Now, instead of that, if you divide 1 million by 20, I'll get 50,000, which is 5% of my total investment. Now, if your company makes investment in 20 different organizations, and let's say in each organization's shares, you are making investment of 50,000. Now, if one company's share price reduces, still logically you will have 95% chances that you will get the benefit. Even the two organizations share prices, they drop, still there is a 90% chance you get the benefit. It means you have spread your risk, you have diversified your risk. So obviously you might have heard one saying, you can say, or idiom, that do not put all of your eggs in one basket. So unsystematic risk is a diversifiable risk which can be spread, which can be reduced, even which can be eliminated. Now listen to me carefully, students. According to capital asset pricing model, which has number of assumptions, but out of those number of assumptions, one of them is, it is assumed that it is assume that investor is having a well diversified portfolio of investment, well diversified portfolio of investment. That is why unsystematic risk is zero. We always make this assumption, okay? So in capital asset pricing model, the assumption is, another point is, look at this. What is the assumption? Who is having a well diversified portfolio of investment? Investor. It's not about the investee. So investor is having a well diversified portfolio of investment. That is why we assume unsystematic risk is zero. It means that logically in capital asset pricing model, this risk has become zero because of the assumption. We are left with only which risk? Systematic risk. It means you have to face the systematic risk. Systematic risk is not a diversifiable risk. Not a diversifiable risk. So systematic risk you cannot diversify. Examples. For example, if your government increases the interest rate, you cannot do anything. Of course, then borrowing will become expensive for you, but you have to bear it. If the government increases the tax rate, you have to bear it. It's a systematic risk. You cannot do anything. So simply there are two types of risk. One, due to an assumption, it has become zero. We are left with only one risk, which is a systematic risk. Now, when it comes to beta equity, actually beta equity is a measure of systematic risk. Now the question is, why beta equity is a measure of systematic risk? Can I say we have already assumed that unsystematic risk is zero. So what is left? Only one, systematic risk. So this equity beta is a measure of systematic risk, which indicates that how your investment will respond. How your investment will respond to the changes in a stock index. For example, if stock index increases by 2%, and let's say your investment increases by 4%, So we'll say your investment is a riskier investment. Why your investment is a riskier investment? Can I say if you are getting return more than the stock index, it means that if the stock index drops, you will be having a loss more than the market. So if you are generating the return more than the market, then be ready. In case of loss, you will be having a loss more than the market. Now, let us quickly see one small example. With main focus will not be on calculation. The main focus will be on interpretation. Let's say we have RF 8%. RM we have, let's say, 15%. Number one, equity beta is 0. Then we have equity beta 0.75. Equity beta 1, 1.5. Student, please quickly give me 4 Ks. You have 2 minutes to attempt this, please quickly. You will have 4 Ks. What are the results? Oh, I cannot see. Okay. Let's go for the number one. Student, obviously, along with the calculation, you need to focus on the interpretation as well. And that interpretation is obviously valid for throughout the entire AFM. Number one, beta equity is 0. Actually, when your beta equity is 0, it means you're making an investment where you are not facing any risk. Beta equity 0 means you are making an investment where you are not facing any risk. Can I say if we are making an investment where we are not facing any risk, it means logically, technically, we have made a risk-free investment. Can I say if we have made a risk-free investment, then logically, yes, you're right. Logically, KE should be equal to RF. And this is happening in number one. If K is equal to, we have RF 8%, RM 15 minus 8, 0 will make entire bracket 0. So K is 8%. Second, if beta equity is less than 1, now listen the interpretation, students. If beta equity is less than 1, it shows your investment is less riskier than the stock index. Your investment is less riskier than the market. Now listen carefully. If your investment is less riskier than the stock index, then you are going to demand a return lower than the market. Actually, RM means average return on a stock exchange. RM means average return on a stock exchange. So when I've made an investment which is facing risk lower than the market, then I'm going to demand a return lower than the market. Now, logically, whatever the KE comes in second case, it must be lower than RM because equity beta is less than 1. Okay, great. So 8 plus 15 minus 8 into 0.75. So I'll get 7 into 0.75. Student, we are getting K 13 25%. So you can see that it is less than RM. Third, beta equity 1 is a benchmark beta. Beta equity is equal to 1 is a benchmark beta, which shows that systematic risk of your investment is equal to the systematic risk of stock index. Now the question is, why I'm putting, can you reply please, student, why I'm putting so much emphasis that equity beta is equal to 1 is a benchmark beta, and where the interpretation is systematic risk of your investment is equal to the systematic risk of stock index. Why systematic risk? Can you please reply, student? Why we are not talking about unsystematic risk? Students, please reply. Why we are saying equity beta is equal to 1 is a benchmark beta? That's perfect. Then I said it means systematic risk is equal. Assumption, yes. Because in capital asset pricing model, there is an assumption that investor is having a well diversified portfolio of investment. That is why unsystematic risk is 0. So we are left with only systematic risk. Great. Now listen, student. Beta equity 1 is a benchmark beta. The interpretation is the risk of your investment is equal to the market risk. So logically, K will be equal to RM. So it is happening in third. K is equal to 8 RF. RM is 15, then 8 into 1. Fourth, if your equity beta is more than 1, if your equity beta is more than 1, it means your investment is more riskier than the market. Please listen carefully. When your investment is more riskier than the market, then you are going to demand the return more than the market. So logically, K will be more than RM. So K is equal to 8 plus 15 minus 8, and equity beta in is 1.5. So K is 18.5%. Now, student, listen to me carefully, okay? Please. Logically, and technically, what will be your KE? Will it be equal to RF, equal to RM, less than RM, more than RM? Can I say it actually depends on equity beta? Yes or no? Please reply. Yes. Yes. Then here comes the interpretation. Extremely important interpretation is KE from capital asset pricing model relates to the systematic risk of investment. Simply what K you are going to get, it depends what is your equity beta. It's very simple. So what K you are going to get, it simply depends on what is equity beta of your investment. Just put it in another words, how successful an individual wants to be simply depends on the efforts. There are other factors also, but obviously the very important factor is efforts. Those are putting, everything, then obviously they are going to be successful. Because there is no alternative to the hard work. There's no alternative to the hard work. But those people, they love to just go to the bed for 12 hours and 14 hours. Normally, I have not seen such people to become successful. So KE depends on the systematic risk of your investment. Now, come in. Let us discuss now the second formula of calculating KE, that is dividend valuation model, or you can say dividend growth model. Simply KE is equal to D naught 1 plus G upon P naught plus G. Students, never make a mistake, which normally marker is not going to tolerate. What are those mistakes? Towards the end of AFM, there's a video also in which I have explained there are 10 mistakes in AFM. You're not supposed to make even a single of them, because those 10 mistakes, they are non-bearable mistakes. Okay. So do not make any one of them. So there are 10 deadly, I would say, sin in AFM. So towards the end of the syllabus, there's a video in which I have explained there are 10 deadly sin in AFM. Do not make any one of them. For example, look at the formula K is equal to D naught 1 plus G upon P naught plus G. If you are using this DVM formula, always, 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 K will be greater than growth rate. Now, if you're using DVM formula and you are getting KE lower than growth rate, it makes no sense at all. Look at the formula. We are adding the growth rate. Okay, now we know the interpretation of KE. Cost of equity slash minimum return required by the equity holders. D naught. Current dividend per share. G is this annual dividend growth rate. Annual dividend growth rate. And in DVM, we always assume that annual dividend growth rate is constant. D naught 1 plus G, that is equal to D1. Next year, expected dividend. Now, next year expected dividend means, let's say D 2025, 1 plus G will be equal to D 26. If it is assuming Dn, then 1 plus G will be equal to Dn plus 1. So D1, next year expected dividend. Okay, now P naught is the current share price ex div, excluding dividend. Current share price, but ex div, excluding dividend. Now, please listen to me carefully. There is one more price, which is cum div, cumulative of dividend, including dividend. We do not use cum div values. We use ex div values. Ex div means excluding dividend. Number one, whenever share price is given, nothing is mentioned. We always assume given share price is excluding dividend. If the share price is cum dividend, it will be mentioned in the question. It is a cum dividend price. Now, another question is why we always use ex div price. Why we are not using in the formula cum div price? There's a reason behind that. Actually, cum div values, cum div share price, cum div means including dividend. Cum div prices, they do exist at a stock exchange, but only for few days. Generally speaking, throughout the year, share prices, they will be ex div, they will be excluding dividend. So logically, I'll be using a share price which is excluding dividend, which is more or less throughout the year. Again, the question is same. Why not cum div? Even it is for a few days. Why we are not using cum div value? There's a answer to that. The answer is, can I say we at the start of the class we have discussed cost of capital objective is investment appraisal, and investment appraisal is a long-term decision. So it is illogical when I'll be using a cost of capital for investment appraisal, which is a long-term decision. So why would I use cum div price? It makes no sense. Cum div price exists only for few days. That is why we go for ex div values, because they exist throughout the year. So that is the logic why we are going for excluding dividend price, why we are not going for cum div price. Let's see a small question. Dividend per share is, let's say, 2. Share price is $10. Nothing is mentioned in price is ex div. Annual dividend growth rate. 12%. We need KE. Now, one thing that's for sure. Can I say whatever KE comes, it must be higher than 12%? We don't know what is the answer, but at least we know one thing. It has to be more than 12%. It cannot be less than 12. Let's use a formula. D naught into 1.12 upon 10 plus 0.1. Let's see what are we getting. 2 into 1.12. 2 multiplied by 1.12 divided by 10 plus 0.12. Students, we are getting 34.4%. Whatever comes multiplied by 100. So we are getting 34.4%. Okay. Dividend per share 0.22 in 2021. Dividend per share 0.26 in 2022. 28 in 2023. In 2024. In 2025. Current share price is 13.38. Cum div. Required is K. Now, student, look at the data, information. Number one, obviously, we need to calculate annual dividend growth rate. After that, K is not a problem. Whenever you have given information like this, how will you calculate growth rate? Now, this is important. Annual dividend growth rate is equal to, you will take the last dividend per share, which is, simply take the last dividend per share divided by the first dividend in the question, first dividend per share. Then 1 upon n minus 1. If you have been given a data of 5 years, power will be 1 upon 4. Actually, growth will start if there's a 5-year time period. So growth will be in 4 years. Because in the first year, dividend comes, and after that, there's a question of growth. Then minus 1. Okay. Now, annual dividend growth rate is equal to, the last dividend they have given us 0.38. Power will be 1 upon, how many years are given? 5. 1, 2, 3, 4, and 5. Power will be 1 upon 4 minus 1. Growth rate. Okay, first dividend per share is 0.22. Okay, I want to look at this also. 0.38 upon 0.22. Logically, 1 upon 4 means 0.25. The power is 0. Logically, 1 upon 4 means power is 0.25. So 0.38 divided by 0.22. I'm getting the power is 0.25. Just a minute. 0.38 divided by 0.22. Okay, the power sign is here. 0.25 minus 1. Students, please check. I'm getting 14.64%. 14 point. Now, I just want to quickly show this on a spreadsheet as well, because some of the students, they just keep thinking how we will calculate this on the spreadsheet. So obviously you will be solving on the spreadsheet, not on the OneNote. It will hardly take 1 minute, maybe less. So let's check how you're going to solve this on the spreadsheet. Let me share this. I hope everyone can see this spreadsheet. Yes or no, please reply. Why I can't see the, okay. Let's see. Simply G is equal to bracket. It was 0.38, am I right? Divided by 0.22. Bracket. Shift and 6. Power is 0.25. Then minus 1. We are getting 14.6, 0.146 if I convert that into percentage. Now into 2 decimals. Is it clear to everyone? How to calculate this growth on the spreadsheet? Can you please reply? Okay, that's great. Because as obviously you need to know how to solve this on the spreadsheet. So here is annual dividend growth rate 14.64%. Okay. Student, there is one more formula of calculating, I would say, growth rate, that is Gordon growth model. Gordon growth model. In AFM, it is simply G is equal to BK. In FM, it is G is equal to B RE, but in AFM, we replace RE with KE. Okay. B is the retention ratio. Retention ratio means if your company is paying the dividend 40%, it means we will say your company is retaining 60%. And we always retain to reinvest. We retain to reinvest. So how do we calculate a retention ratio? Is actually B is equal to 1 minus payout ratio. When we say payout, of course, organization, they pay from return from in the form of dividend. So how do we calculate payout ratio? Simply D naught upon EPS. Dividend per share divided by earning per share. Dividend per share divided by earning per share. You will get payout. Okay. Now come in. For example, I want everyone to attempt this question, please. Dividend EPS formula also. Simply profit after tax divided by total shares. Total ordinary shares. Obviously, even in FM and AFM, you are not supposed to use entire IS 33 to calculate EPS. So it's very simple. Simply profit after tax divided by total ordinary shares, you will get earning per share. Okay. Dividend per share is $2. RF is 6%. RM is 13%. Beta equity is 1.5. Earning per share is 8. Required. We need P naught, current share price. Dividend per share is $2. RF is 6%. RM is 13. Equity beta is 1.5. EPS is 8. And we need P naught. Please, I want everyone to attempt this question. You have 3 minutes to attempt this. Okay, student, let's try together. Simply, we can easily calculate KE first. RF is 6%. RM is 13 minus 6 into 1.5. 13 minus 6 into 1.5 plus 6. Students, I'm getting K is 16.5%. Okay, now payout ratio D naught upon the dividend is 2, EPS is 8. So payout ratio is 0.25. If payout is 0.25, then retention is 1 minus payout. The retention ratio is 0.75. Annual dividend growth rate 0.75 into 16.5. Annual dividend growth rate is 12.375%. 12.375%. Okay. Now, the normal formula is K is equal to D naught 1 plus G upon P naught plus G. But actually, we need P naught. So if I make P naught a subject, then P naught will be equal to D naught 1 plus G K minus G. P naught is equal to. Okay, just 1 minute. Let us spend on this also, because not everyone, but few students, they also think how it is possible that we are getting this P naught. Yes, like one student has asked K minus G, how did you get this? Just let us spend 1 or 2 minutes on this. Basic maths, and I hope everyone loves maths. This is plus G. If I'm going to bring this plus G on the other side of is equal to, it will become negative G. Yes or no? A pure maths, simple maths. Student, is this clear to everyone? Plus G, if it goes on the other side of is equal to, sign will change, it will become minus G. Then, is this clear? K minus G, yes or no? Please reply. If it is positive G, so very simple maths, you're going to bring on the other side of is equal to, it will become negative. Now, P naught, if I'm going to bring this P naught on the other side of is equal to, here P naught is in the division. If I bring this P naught on the other side of is equal to, it will multiply, P naught will multiply with K minus G is equal to D naught 1 plus G. Now they both are multiplying with each other. So if I bring K minus G on the other side of equation, so this is the derivation. You can not a derivation, just I hope it is clear to everyone that P naught is actually equal to D naught 1 plus G K minus G. Now it becomes very easy to calculate P naught. Current dividend is 2. Growth rate we have calculated 12.375%. So 1.12375. KE we have calculated 16.5. So make it 0.165 minus 0.12375. So simply 2 multiplied by 1.12375. In the numerator, you will get 2.2475. In the denominator, 0.165 minus 0.12375. So 2.2475 divided by 0.04125. 54.48. I hope this entire calculation is clear to everyone. And one more thing, students, you should have noticed, even though it's a live revision class, more or less, I have discussed almost each and every concept. Still, a lot is left in cost of capital, which we are going to cover in the next class. As I mentioned at the start of the class, the first two classes, the time duration will be less. And then after that, obviously, duration of the class will increase. And on each topic, you will be getting the short notes as well. Like these are the very precise, extremely precise notes, I would say, on cost of capital. We'll be discussing this as well. Don't worry at all. Everything. So on each topic, when I say each means each, either it's a business valuation, investment appraisal, dividend policy, corporate reconstruction, forex. On each topic, you will be getting a short notes as well. Already detailed notes. My book 1 and book 2 is with you. And in book 2, at the end of book 2, I've also compiled all the theoretically frequently asked questions are there in book 2 as well. So students, it's just a first class. I want to end the first class here. Inshallah, in the next class, the duration will be a little bit longer than the first class, and we'll be covering other areas of cost of capital as well. So just the last minute of the class, if you want to say anything, you want to ask anything, you can ask before we end today's class. And let me tell you one thing, we are conducting these live revision classes in every paper. Like yesterday, I took a class on SBR. It was a live revision class on SBR. After your class, there's a class on live revision class I have on ATX. Similarly, I'm taking live revision classes in my skill level papers as well. So in every paper, and let me tell you, objectives of live revision classes. Objective number 1, to give you the revision of entire advanced financial management in a very short period of time, around 18 to 20 hours, you will be getting a revision of entire course. Plus, we will be discussing the recent past papers as well. How do we discuss the recent past papers? First, I'll share the past paper with you. I'll give you around 3 to 4 days, and then we'll be discussing those questions in our live revision classes. No, I don't teach APM, but in my college, you will get APM as well. So APM is in my college, each and every paper is available, and each and every teacher is excellent. So APM, if you are interested in APM, APM is also available, but I'm not teaching APM. I do teach PM, but not APM. Okay, students, so that is all from my side, but let me tell you, ATX passing rate is better than APM, and I'm teaching ATX. Okay, students, see you all inshallah in the next class. Do give the feedback on today's class in your respective WhatsApp groups. Your feedback actually obviously motivates the teacher and admin as well. So you can check there's a huge difference between the passing rate of AP and ATX. APM is around 33 to 34%. ATX is around 47%. A really big difference. Okay, students. Thank you very much. See you all inshallah in the next class.